Hey guys, good morning. Chapter 17, Real Estate Investments, Business Brokerage and Auctioning, the pointers, Florida Real Estate Sales Associate course, the important bits. The most important factor underlying every investment decision is economic soundness. Static risk is risk that can be offset with insurance, which includes fire, flood, robbery, and so on. So anything that can be covered by insurance is called static risk. Positive leverage occurs if the investment returns more than to the investor than the cost of borrowing the money necessary to purchase the investment. So to borrow money always costs something, and positive leverage is when the return on the investment is more than the person paid. So basically the only investment that's worth doing is one with positive leverage. Okay, net operating income minus annual debt service, which is 1 year's mortgage payments, equals cash throw off before tax cash flow. The type and amount of financing is dictated by the needs of the investor, not the property. It would be inappropriate to charge a property for something unrelated to its operation. Operating expense ratio equals operating expenses over effective gross income. Loan to value ratio equals loan amount over property value. Calculating profit on investment. Assume an investor paid $100,000 for a parcel of land, divided it into 3 separate lots, and sold each lot for $50,000. What would be the profit on this investment? Made divided by paid equals profit or loss percentage. Solution: 50,000 times 3, which equals 150,000 gross sale price. 150,000 gross sale price minus 100,000, which is price paid, equals $50,000 profit. $50,000 divided by $100,000, which was, price paid, equals 0.50 or 50% profit on investment. Profits from investments are calculated on the amount originally invested, not on the amount received when the investment is sold or liquidated. Tax law currently allows owners of residential and low-income investment properties to depreciate a portion of their investment over 27.5 years on a straight-line basis. The residential category includes single-family rentals, all apartment rentals, and mobile homes. The owners of non-residential investment properties may depreciate a portion of their investment over 39 years, also on a straight-line basis. Hotels and motels are classified as non-residential. Example: an apartment complex was purchased for $100,000. Closing costs were $10,000. An appraisal indicated the improvements represented 75% of the value of the property. What amount may the investor deduct each year for tax purposes? Step 1, $100,000 plus $10,000 equals $110,000, which is total acquisition cost. Step 2, $110,000 times 0.75 equals $82,500, which is basic for depreciation. Step 3, I don't know how you say it, 82500. Divided by 27.5 equals $3,000 per year cost recovery. 82,500, that's how you say it. It's the morning. I beg your forgiveness. Tax deferred exchanges. Any capital gain realized from the sale of investment property may be transferred into another property by exchanging properties with another investor. This is a 1031. Any investment real estate exchange for other investment real estate is called a like-kind exchange. The problem with this type of transaction is that most properties will not have the same exact value. Therefore, in order to conclude the exchange, investors will often have to include cash or other forms of unlike property to equalize the transaction. Unlike property received in a tax-deferred exchange is called boot and is taxable to the unlike property received in tax-deferred exchange is called boot and is taxable to the recipient. So this is a 1031, which is a like-kind exchange. The appraisal of a profitable business presents a unique challenge. The value of the business is not just the value of any real estate owned, but rather a composite of the values of the real estate, personal property, and intangible assets such as licenses, franchises, non-competition contracts, and so on. When the value of all assets is combined, it creates what is known as a going concern value. So a business that's existing, including personal property, intangible assets, licenses, franchise, non-competition contracts, etc., is altogether called the going concern value. Reasons for a business appraisal. Business owners or potential purchasers may request an appraisal to establish a sales or purchase price, obtain a loan for obtain a loan, or for insurance purposes. Other reasons include condemnation, buy-sell agreements, property settlements, estate settlements, or to be used in connection with employee stock option plans. Assets are items of value owned by a business. Assets includes account and promissory notes receivable, cash, inventory, production machinery, real estate, personal property, patents, trademarks, and goodwill. The value of the goodwill, parentheses, the value of the name of the business in the marketplace. That's it. We're finished the pointers for chapter 17, and I will see you back for the next chapter. Oh my god, I sound like the guy in the course.